Okay, well, good morning, everybody. How's everyone doing today? So we're going to go ahead and get started with where we left off last time, and we are covering chapter 3 in the text, and we're going to talk more about that and sort of finish that up and sort of just kind of give you a bit of an overview as to where I think we ought to be here. So this is just sort of a copy of my syllabus here, and as I've noted in the announcements and also in any other communications I've had with you, that I deferred. Oops, I went the wrong way. I deferred the due dates for chapters 2, 3, and 4 activities a week in order to sort of allow you more time in order to do what it is you need to do. So for this week, obviously, chapter 2 is due on Sunday, 2 days ago. So in chapter 3, the Smart Book quiz, there's also discussion posting that you want to do by this Friday. And so, as I mentioned in my announcement on yesterday, you still have plenty of time to do that, as well as really all of this. And so in chapter 3, homework and bonus, if you want to do the bonus, and some people do the bonus, some don't, but it's extra credit, so there's no reason why you should not do it. So I would encourage you to do that. And so this is, I want to wrap up chapter 3 today. There's a lot to do, and when I think of intermediate accounting, I think of generally the idea there's always a lot to do. And it's a dense course, it's a dense set of courses. In fact, usually we break it into 2 pieces, intermediate 1 and intermediate 2. And there was a trend a few years ago to make it 3 sections, 1, 2, and 3. And so we sort of reconsolidated back into 2, but there's still a lot to do. And there are a lot of things we're covering. And as I said at the outset, at the very beginning of the course, when I think of intermediate accounting, what I think of is the not only the gateway to the profession of accounting, but from the standpoint of coursework, it's really sort of a walk around the financial statements and drilling down into those, and also a discussion of certain methods as to how we treat certain transactions, events, etc., in accounting. And so what we're going to do today, we're going to finish up chapter 3, and I do not believe I'll be done by the hour and 15-minute sort of timeline here, and I've got to be out of here because there's another course that comes in, another section that comes in. So I'll come in later and record a second video, which I'll probably be doing. It's sort of the way it goes, and it's fine because I would rather have you have this information as opposed to less. And I'm pretty much here every day, so if you have questions, feel free to get with me, and I'm more than glad to sort of cover what those are. So we're going to cover the rest of the balance sheet and financial disclosures, and we'll talk a lot more about what these look like and what the purpose of financial reporting is in general. Now, remember, financial accounting is really geared toward the providing of information to external users, and that's really the goal of what financial accounting really is, as opposed to cost accounting and managerial accounting and whatnot. And so we're trying to disclose to users what's going on with a particular company at hand. And I say company because we're primarily, well, I should say exclusively talking about privately owned companies, publicly traded for the most part. So, and the publicly traded example is going to make itself manifest as we get into things like stock and preferred and common, all that. So, all right. So I think we left off last time talking about different parts of liabilities. And one of those fits into the category of current liabilities, and that's current maturities of long-term debt. So what's going on here is the idea we have long-term debt that the company has borrowed for all kinds of purposes, but yet some of it is coming due in the next accounting period, which frankly is a year. I know that the sort of the wonky academic accounting definition is a year, or the operating cycle, whichever is longer. And yes, that is the correct definition, but really within a year, and I mean, is the, sort of the practical example here. So things that are doable within a year, we sort of push forward. We take out long-term liabilities and move up in the liability section of the balance sheet. In other words, the right side of the balance sheet. And so we have long-term notes, loans, mortgage, whatever, and that are payable. Now, not interest, but it's the principal amount. And so we sort of move that up. And accountants are very good at doing this, saying how much is going to be payable within the next year, and we got to move those up in the current liability section. So the example here is we have $1 million note payable requiring 100,000 principal payments to be made each of the next 10 years. So let's not worry about interest. Interest is really interest expense is an income statement item. What we're really interested here is in how we treat the liability itself. And so it's a 10-year note. So it's, I guess, principal plus interest looks like. So 100,000 is a current liability. We move up into current liabilities, which means we deduct that 100,000 from the long-term liabilities, and we simply move it up. So current maturities of term debt is simply accounting for what's coming due within this accounting period. And why do we do this? We do it because we want to know what's going on at any moment with regards to liquidity, right? And liquidity, we're going to get to liquidity a bit later. If not in this particular video, I'll get to it a bit later. But liquidity is really an issue of short-term ability to meet obligations. And so in a corporate accounting environment, usually the corporate treasurer is charged with making sure that all these elements are covered. That is, how are we going to treat this $100,000 that's due in this accounting period? Are we able to do it? If so, how are we going to be able to do it? So that's really kind of an issue there. Okay. All right. So let's talk about. Let's go on from here and talk about some of the rest of the issues on the balance sheet here. And my cursor will work here. Where's my cursor? There it is. All right. So let's talk about long-term liabilities. All right. So this is the current maturities of term debt is really sort of a natural bridge, I guess, to the issue of long-term debt. When we talk about long-term liabilities, remember, liabilities in general are claims against the firm, and more specifically, a claim against assets, whether those assets are earned or have yet to be earned. And so long-term liabilities are those things which have long-term obligations and claims against the firm. So, and what form do they take? They usually take notes, that is, between one party and another party, in other words, a lender and a borrower. In this case, we're looking at, since we're a liability holder with a borrower, right? I say we like we're the firm itself, but it can also be a bond issue, which is issued to many, many borrowers. And bonds are something we talk a lot about in intermediate accounting. It's a long-term bond. It's a long-term debt issue that is issued to many, many, many borrowers, many of whom have no or, well, actually, incidental or no connection to the borrower at all. And so they're just simply traded in the public markets. And so these are all, well, let's talk about the definition here. They're long-term obligations due to be settled and have a contract right by the borrowing company. And also they have impact on future cash flows. And usually they're specified in what we call a bond debenture, which is kind of an old school term. We're spelling out what are the repayment terms, what is the interest rate, which is usually fixed. There are variable rate bonds out there, but not as much as what you might think, I believe. Interest rates, which is a sort of a locked-in rate. Other details in the disclosure. And so long-term obligations are these things which a company owes to a creditor, okay? So on the right side of the balance sheet, we come back to this idea that I talked about long ago, which was the idea, on the left side, we have the owner's equity. On the right side, at least up until we get to shareholders' equity, the equity side, we have creditors' equity. And that is creditors, whether they have a legal security interest, as a collateral interest, a legal right to go seize assets, whether or not that exists at all on a formal basis, they nonetheless have a contractual and a legal right to seize assets if there's a default on the part of the borrower. And so obviously, if you're a borrower, there's an issuer of bonds, an issuer and borrower, the same thing in this case. You don't want to default on those unless you want the ramifications, which nobody does. And so as a result, long-term liabilities are these things which have long-term obligations. And the thing we should talk about long-term liabilities, and I think we get into this more in intermediate two, is the idea, what are we doing with long-term liabilities? Why are we borrowing these gigantic sums of money over very long time periods? What are we trying to do? Well, maybe we're trying to expand assets. And so the rise in liabilities matches the rise in assets. Maybe we're trying to refinance other debt. You know, it's really hard to sort of summarize what's going on, but it's not unusual at all for companies to have long-term liabilities. In fact, it makes sense sometimes to have long-term liabilities. In fact, we're going to talk a bit later, if not today, then in my subsequent follow-up video, about this idea of capital structure and how rational firms will finance their assets and how they do it with a combination of equity and debt. And debt is not quite what you think it is. And I think that's one of the interesting things about debt is it may defy what some conventional wisdom has to offer on that. Okay. All right. Any questions? I'm checking the chat box and I see nothing, or the Zoom link, and so but feel free to reach out to me. I'm here and able to answer your questions if you want. So quick quiz question: the key distinction between current liabilities and long-term liabilities. Well, it's got to be C, the length of time, and so it's obviously current liabilities are those liabilities which are to be settled within a year, or the operating cycle, whichever is longer. For the vast majority of companies, it's a year. And so most of the time, that sort of very formal definition doesn't apply. It's usually within a year. Long-term liabilities are those which are settled with over a year, knowing, of course, with the caveat that there are those obligations which are due within the current year. And so as a result, long-term liabilities do become a current issue in the sense that they do have to be paid on a current basis. This is, and by the way, this is not that unusual from, individual borrowing where we take out a car loan, right? So we borrow $30,000 to buy a car, 5-year loan, whatever, and we're making monthly payments. Well, some of that principal that we're paying is due this year. In other words, the operating cycle. And I know that I sort of hesitate, I've long hesitated to sort of link households and businesses because the metaphor doesn't usually work. But in this case, it's maybe suitable as an example. We're going to pay for a car buyer financing a vehicle. We're going to pay some of that principal this year. And so as a result, it's a long-term liability where the obligation is not deferred forever. It's coming due in a fairly short manner. And creditors, funny thing about creditors, they want to get repaid with interest, and they want to get their principal back with interest on a timely manner with interest. And so that's kind of what's going on there. So much more about liabilities a bit later. But again, this is sort of a walk through the balance sheet to talk about what is going on. Okay. All right. To sort of wrap up the final category on the right side of the balance sheet is shareholders' equity. Okay, and in intermediate 2, we get much more, we drill down a lot deeper into the shareholders' equity. We talk more about things like, restricted stock and stock buybacks and all that. But shareholders' equity is basically the owner's equity portion of the equity side of the balance sheet. It is the right side. So what is it? Well, we come back to something we talked about in Principles 1, and I know I keep going, I sometimes say Principles 1 and 2110. It's the same thing here. And I know a lot of our students did not take introductory financial accounting here, but it's covered there with the basic accounting equation is assets equals liabilities plus shareholders' equity. If you subtract liabilities from both sides, you get shareholders' equity, right? So assets equal, right, liabilities plus shareholders' equity. All we've really done is subtracted liabilities from both sides to isolate this variable. And we talk about shareholders' equity. Again, we come back to this idea that focus in really all of college accounting that I can think of, unless it's specifically defined elsewhere, is publicly traded corporations whose shares and whose equity and debt trade publicly. And so shareholders' equity is that portion which is the residual, frankly, of the assets which are not claimed by creditors. And there are 2 categories. And it's paid-in capital, which really is more from the outside, it's more external financing or funding to the company. And the retained earnings, which we call earned capital, again, the green that I sometimes insert within my slide package is earned capital, which is where we're earning income. And this is income that becomes what we call capitalized. We do not distribute it to shareholders for whatever reason. And there are a lot of companies that do not distribute earnings to shareholders. A lot of the tech companies, who's, NVIDIA and Apple, they don't really pay much of a dividend back to their shareholders. They just kind of let the shareholders take a ride upward of their stock price. And so they do what we call capitalizing earnings. They don't distribute them back, and they're not taxed away and whatnot. But paid-in capital is different. It's usually in the form of some sort of formal issue, where not just the original issue, but also subsequent issues and whatnot. So paid-in capital is a little bit different. Paid-in capital was one thing, retained earnings is another thing. Paid-in capital will be discussed much more in intermediate 2 in terms of what we're doing with it, but this is an important distinction to be made between paid-in capital and earned capital. Earned capital is one of those things which we are accumulating assets, and we simply put it on the balance sheet on the left side as an asset, and on the right side as a liability. So we have an asset, debit balance, a credit balance for shareholders' equity, and those both balance, okay? Sometimes called net assets. That's not really a term used very much. Or book value. Book value is used, and book value is got problems, frankly, when it comes to valuation. And in the financial world, book value is something that's looked at, but it's maybe not the most important value in terms of assessing what this company is quote unquote worth. And so, given the limitations of financial accounting, and keep in mind we have a lot of assets that are booked at historical cost. We have things that we are estimating, we don't really know sometimes, and it's sometimes difficult. And book value, one thing about book value, and I think I mentioned this before, is the idea it doesn't really account for the future cash flows that might arise from the company. So book value really is it flows out of the balance sheet, and the limitation here is the fact that the balance sheet doesn't necessarily project, predict, indicate future cash flows, which would be manifest in the income statement. And it sounds a little bit incongruous because we talked about the fact that of the two of the four major statements in financial accounting, the balance sheet and income statement are far and away the most important, with the balance sheet being in many accountants' eyes to be the most important. So you might think, well, why is the balance sheet most important when we're not really taking into account the earnings that would be reflected on the balance sheet, which are not reflected? And so how do we really account for that? It's difficult, and this is one of the issues that we need to wrap our minds around as we contemplate what the value of the balance sheet really is, okay? But this is why we have all kinds of different subjective judgments as to what's going on, and so we have to kind of take into account these particular subjective judgments. First of all, we have no idea what the future holds, and so it's one thing to say, hey, these assets can create this amount of income, but we really don't know, and we'll find out when it happens, right? And then one final thing here is accumulated other comprehensive income. So we talked about OCI, other comprehensive income, a bit earlier, and we said that what is this? Well, it's something that doesn't belong in the income statement. I'm not talking about accumulated other comprehensive income. I'm talking about OCI, which is an income statement item, which is usually detached from the income statement because it really doesn't reflect the operating results of the enterprise within the period that we're discussing. And what's really going on here, primarily there are a couple of things, in particular because companies today are multinational, we do business all over the world, and we have different valuation adjustments we have to make. And we simply, these are known formally as currency translation adjustments, and those typically are a fairly prominent piece of this on the income statement. All right, so that's OCI. It's an income statement item. And by the way, I've seen OCI entered as a separate line item, actually on income statements, even though the example I gave you the other day was of Apple, where they had a separate statement. And that's typically the case because it really doesn't reflect what's going on with the management itself. And by the way, OCI sometimes is really outside the control of management generally. So I think managers, I guess the cynical view is managers simply want that to sort of go to the side because they really don't control that. It's currency issues, pension valuation adjustments, those are kind of the big issues there. But all right, so those are income statement items. We're talking about the balance sheet here. So we're talking about accumulated other comprehensive income. It's kind of hard to say, accumulated other comprehensive income that goes into the balance sheet as a part of shareholders' equity. And it's really the accumulation of all these, additions, subtractions over time that shows simply an adjustment to shareholders' equity. These are non-operating items, but not only are they non-operating, they're really things that are sort of outside of the control of management, but nonetheless are part of the disclosure requirements. And for those of you who are going to go on to take the CPA exam or maybe go further in accounting, you'll see that there are a lot of regulations that reflect how they're intended to guide accountants as to how they report certain things, and based upon what criteria and all that. So these are not unimportant issues at all. Okay. Example here, Nike. All right. So what have we got going on with Nike? We have shareholders' equity. We have common stock. And remember, common stock is oftentimes a very small number because it really represents the initial issue of stock, whatever that was. And there are some companies that have been around for a very long time. Procter & Gamble since the 1850s, Pfizer since the 1840s, where these initial common stock issues were probably very, very small. But they've, I'm sure, added to them because they've done new issues over time. And so these numbers have gone up. But it's not unusual to see a very small common stock issuance. And this is something we get into a bit later, the idea that companies will issue more stock and sometimes buy stock back. And so common stock is a fluctuating value, which is really, frankly, 100% under the control of management. Additional paid-in capital usually represents a premium over a sort of arbitrary par value. More on that a bit later. And then retained earnings. So this is basically the paid-in capital and then the earned capital, which is retained earnings. And a lot of companies have a very substantial amount of retained earnings. And then this final issue here of accumulated other comprehensive income. This is fairly old data, 2016 to 2017. May 31st looks like they're a year in. And it looks like they went from a positive AOCI to some negative. I don't know what that is. I haven't looked into it, but nonetheless, that's part of the picture that they're reporting for shareholders' equity, at least this portion of the balance sheet. So as a result, shareholders' equity is adjusted for all of these things. Now remember, shareholders' equity or stockholders' equity, same term, owner's equity, all these are the same term for the same thing. All these reflect the plug value that reflects the difference in interest in assets. So remember, if you think about the balance sheet, you have assets equals liabilities plus stockholders' equity. Assets are those things which are defined as resources that are owned or controlled by an enterprise, right? And there's a longer definition that goes into things like as a result of past transactions, whatever. But that kind of focus on that. But then you got the equity side, which is claims to those assets. And a lot of those are, frankly, in the form of creditors. We call creditors equity, and that's short-term obligations like accounts payable that the company owes to a supplier, or wages payable, or income taxes payable, something like that. It could also be a long-term debt payable, which we got into. But those are creditors' equity, but to balance that out, we have owner's equity, which we simply call shareholders' equity or stockholders' equity. And we have these different layers, the two main categories being paid-in capital and earned capital. And within that, though, we've got a lot of different areas to go. And I realized that within the issue of shareholders' equity, we could probably do a number of weeks on this subject. And there are all kinds of different obligations going on here. Notably, things like stock options paid as a compensation. But it's beyond the scope of what we're doing here. I just do want to point out the fact that the balance sheet has to balance. And assets must equal liabilities plus shareholders' equity. If it doesn't, we got a problem. We have to figure out what's going on, right? All right, so any questions so far on the Zoom call or elsewhere? All right. All right, so let's talk a bit about the international issue. This course is primarily geared toward GAAP standards. However, we will talk intermittently about the IFRS standards, and there are some differences. And in a lot of ways, I got to say, I am kind of a fan of the international standards, and I would really wish that we sort of push our way more toward unity here. But it's been difficult. It's slow and challenging and whatnot. But nonetheless, what are some of the differences here? In the international standards, there are a minimum list of items to be presented. That's probably one of the minor points here. But one of the big ones here is this idea of changing it's here, the idea of current assets in the GAAP standards, which we've been sort of teaching here. Current assets come before current assets. I'm sorry, non-current assets. So current assets first, long-term assets below current liabilities, and then non-current liabilities. it's somewhat backwards. And if you've ever seen the statement presented in the IFRS standards, it's a little bit different. It's a little bit weird. You got to kind of piece it through, particularly for those of us who've been looking at financial statements for a very long time. You got to kind of see what's happening. Also, what's interesting is the very first international accounting standard, number one, which refers to the balance sheet as a statement of financial position, which, by the way, used to be what we refer to the balance sheet as formally as the statement of financial position. Today, we simply call it the balance sheet, which is a much more informal term, but we used to actually call it the statement of financial position, and balance sheet was sort of a slang term applied to it. But that's, so those are some changes. Now, are they minor? Yeah, in this regard, they're minor. Again, as I mentioned earlier on, as somebody who's I've spent quite a bit of time reviewing some of the international standards. Probably the biggest issue by far is that of asset valuation. And we will talk more about this, particularly for those of you who are going to take Intermediate 1, this course, as well as Intermediate 2. We do try to incorporate some of these because we know that a lot of students will go on to work for companies that are international in nature. And so once you do business overseas in other countries, and when I say overseas, it's pretty much everywhere else. Everywhere else deals with international standards. And so as an accountant, you would have to deal with these particular standards, which are different from here. And that's kind of the landscape right now of the accounting profession. Okay. All right. So let's kind of move on here. And again, I really do not think I'm going to get through everything here that I want to talk about, but I will follow up later. So concept check with a quick quiz, GAAP versus IFRS. And so which of the following is true regarding GAAP and IFRS? There are more differences than similarities. I would not agree with that. IFRS specifies a maximum number. No, because it's a minimum number. Many companies reporting under IFRS present non-current assets before current assets. That sounds right. So as a result, the answer to this is going to be C. The correct answer is that they present non-current assets and of current assets. What the logic of this is, I honestly do not know. I would tell you if I knew, but I do not know. And so, but nonetheless, there are some differences. And excuse me, I've seen my share of statements, European companies primarily, who are reporting their results publicly, and the statements do differ, and they're kind of difficult to look at, particularly for those of us who are our eyes are sort of attuned to looking at things in a certain order. And so these are things that are just sort of the landscape of the differences. Again, are we moving toward a conversion of GAAP and IFRS standards? I'm not so optimistic. And but should it happen? Well, it depends on the eye of the viewer. Personally, yes. But what I think it makes no difference whatsoever. And so these are sort of the differences that exist. All right. All right. And then annual report disclosures. We're going to spend some time talking about this. This is really important because when we talk about financial accounting, I think the end result, the final product is what's really important here. And it is producing quality reports for external users. We've talked about this again and again and again in this course. And we talked about it a lot in 2110 or Principles 1, where we're saying that the users of financial statements are those who are to whom the benefit is being bestowed. And that is investors, creditors, lenders, regulators, the general public, whomever, labor unions, whomever. And so we are tasked with doing our best to produce an annual report. So the annual report, which goes to and again, we're talking about publicly traded companies in the US, they produce what's called a 10K report. It goes to the SEC, the Securities and Exchange Commission, which is our ultimate regulator. It's the government entity that doesn't really monitor things on a day-to-day basis, but they kind of intervene when major questions need to be resolved. And FASB does what it does, but FASB is not the government. The government is at the SEC. And so so companies will upload not just on a yearly basis, but also on a quarterly basis, which may change to semi-annual. We'll see what happens, but they upload these. The quarterly statements are called 10Qs. The annual statements are called 10Ks. And so what is going on here? The annual report includes financial statements, the balance sheet, which we're talking about in this chapter, also the income statement, statement of cash flows, and a bunch of other things. And disclosures is really where the action happens. And this is something that looks like, I would say probably to the uninitiated, it looks like fine print and doesn't really mean much to people, but it's really where the action is, because it's one thing to report the very line items, which are extremely detailed and whatnot, but nonetheless don't really reflect what's going on. So I'm going to pull up for you, if I can here. And I'm picking on Apple. Not that I like Apple. I think it's a phenomenal company, and so I'm going to pull up their 10K report from the EDGAR website. So again, EDGAR is the website maintained by the Securities and Exchange Commission, right? The ultimate regulator over the publicly traded companies. And EDGAR stands for nothing more mundane than electronic data gathering and retrieval. And so companies upload this information. So any company, and I'm just picking up Apple, I think I looked at Pfizer earlier, and we'll sort of go back and and pick up different companies, but this is one that's sort of notable here. And so what are we really getting at here with regard to this? I'm going to go to, first of all, one beautiful thing about the internet is you can kind of scroll down. These annual reports are very, very long. And by the way, if you're an owner of a company, if you own, I don't know, one share of stock, I guess, in a company, a publicly traded company, that they would send you, you're entitled to their annual report. They would send you, and back in the day, it used to be physical things. And I know my wife got really irritated about all the annual reports we had lying around my house. And more of these are more electronically delivered items, and they're just kind of stacking up and whatnot. But they're available. And the good news is, though, they're available here and they're never going to go away. And you can click on things that you want to see. So let's do some clicking around here, and in sort of to advance what this this particular chapter is going for. So let's go to risk factors first of all. But first of all, before I do that, let's just kind of let's tie it into the content material here. So we talk about additional disclosures, which we call the notes of financial statements, which go on and on pages, hundreds of pages sometimes. We're talking about things like what's going on in business conditions, what are the macro conditions which are going on, both domestically, internationally. Internationally sort of fits this issue. Are there conflicts around the world that we should worry about? Are there resource price increases? What are the issues that we should be concerned about with regard to business conditions? Other risk factors. Legal proceedings, we're going to talk about this because this is the area that I think is not talked about enough, and that's the idea that most companies are involved in some sort of litigation, often as a defendant because of people suing companies because they have big pockets over things that they've done. And maybe they have a claim, maybe they are right to claim that. But one of the things I can tell you almost for sure is that almost every public company you pull up in these EDGAR filings or anywhere else, or if you get the statements yourself, excuse me, they're going to be involved in some sort of litigation, and it's just part of the nature of the business world right now. There are things going on, and people have claims against others, and so. But from an accounting standpoint, and I'm not an attorney, and so I cannot speak too authoritatively about the issues, the specifics of litigation. But from an accounting standpoint, there are different areas and different ways in which we disclose potential liabilities. Because I think the big issue here is when we talk about risk factors, we're talking about what is the risk of the company, what the risk to the company from these lawsuits, whatever the case might be, right? And so we have to set aside assets in order to pay those claims should they arise. So let's take a look a bit about this. Now let's go back to Apple's website here, or Apple's filing. So let's go to risk factors, and there are hyperlinks here. And let's click on the risk factors. Now there's not a lot here. There's not a lot going on. They do focus on macroeconomic and industry risks. And they talk about the idea of adverse macro conditions such as slow growth, recession, and whatnot. But there's not really something that's very specific there. So we're not really terribly interested in that particular issue. But it could be, particularly for those companies who have lots of sensitivity to the macroeconomic environment. Okay. What I do want to focus on is legal proceedings. Boom, right here. And legal proceedings, you've got, in this case, sometimes these are filed by private plaintiffs, that is individuals or other groups who are feel like they have a claim against the company for whatever. And this is required a bit of disclosure where you've got these things going on. In this case, this is the European Union and the European Commission, which is filing a claim against Apple, and we'll see what happens. We don't. It's pending. As this is, by the way, this is end of the fiscal year 2024. If it's been settled since then, I don't know. I don't really follow these things very much, but I do follow these issues in terms of how they impact the disclosures. Department of Justice. I do remember when the Department of Justice did file suit against Apple for antitrust violations, and the antitrust and as Google as well. I don't know what's happened with that. That may not be a current event, but who knows? And then there are other kinds of things, and so they want to sort of disclose what's going on. And I bring this up only because it's a risk to business. When we talk, for those of you who are going to go on to do a bachelor's or an MBA or whatever, one of the things we talk a lot about in those courses is what are the external risks to the company, and then sometimes lawsuits are the risks of the company. These are things that you think you're doing everything right, but there's a product defect or somebody's done something wrong, and so as a result, it's exposed the company to risk, and as a result, the company has to disclose that when it becomes material and when progressively it's known more as to what is the actual cost going to be. And then finally, a couple things here, and I'm going to sort of skip a little bit ahead because we're going to come back to this, is we're going to talk about controls. And if you took 2110 here, I know we talked a lot about controls. And again, we click on the hyperlink and it describes, and this is a requirement since 2002, the Sarbanes-Oxley Act, which required public companies to disclose and discuss what their internal controls were. And then furthermore, and I'll scroll down here a bit, the CEO and CFO specifically, individually, have to sign off on saying, yes, we agree the internal controls are in place, we have examined them, and we're satisfied that these are there. Remember, internal control is this idea, it's not just controlling cash, it's also about things like, are we doing the right things? Are we doing the reporting? Are we preparing our statements in accordance with GAAP and all that, right? Are we preventing fraud? Are we uncovering fraud? When we detect it, are we doing something about it? And it sounds like this should be completely obvious. However, I hate to say it, but there have been lots of companies, way too many companies, that have engaged where people are involved in fraudulent activities. And I'm not talking about just people working on the docks on the front lines. I'm talking about big time executives involved in things they shouldn't be doing. And so, in other words, illegal activities. And it's a difficult thing to sort of sniff out, particularly when it's a very top manager. And but nonetheless, if they're illegal, and in the U.S., if you're a U.S.-based company, we also have anti-bribery laws that sort of impede the ability to do things, and that in itself is a whole other subject, which let's just kind of put that to the side for now. The point is, though, that these are elements of control. The bigger issue with control is not so much about fraud, but rather are we controlling assets, and are we maintaining a sense of internal control? Internal control is really one of those key topics that pop up again and again in accounting. And then finally, skipping all the way down here, there's this, again, this is Apple's website, but we can, or filing. So it's signed by and signatures are out there, but these are the virtual signatures. Tim Cook, the CEO of Apple, and Luca Maestri, the CFO, and they have to sign off individually saying that, yes, we have examined the internal controls, the financial statements, and we are certifying to the world that these are correct. Now, this was something that only started after 2002 with the Sarbanes-Oxley Act, and it kind of, I guess, was disturbing to some companies that didn't want to do this because they didn't want to personally be on the line. This is putting Tim Cook on the line, for the internal controls of the company. So, but if you don't want the job, don't take the job, is what I would say. So it's the law of the land, and so you have to sort of comply with that particular requirement. Okay, and so all this came about, and we've talked about Sarbanes-Oxley as a big piece of legislation early in this century about how to deal with what were not widespread. I don't even think it was widespread abuses. I just think it was isolated abuses, but had the potential to be very, very devastating. So the accounting profession is relied upon to be accurate and to be truthful, and we pride ourselves on that. Okay, we really do pride ourselves. And if you don't want to pride yourself on it, this is not the right place for you. All right, it really isn't. It really is not. So we pride ourselves on accurate reporting, good, bad, ugly. And if management doesn't like it, then that's the way it is. And if anybody doesn't like it, that's the way it is. So, and also within disclosures, we have all kinds of other examples, which we've talked a bit about before. And one of the things that I underlined here was must include a summary of significant accounting policies. These are things like how do we value inventory, how do we value things like how do we do depreciation allowances, bad debt allowances, whatever. There are all kinds of issues, and there are all kinds of things which we do estimates of, but we need to disclose what those are, right? And any related third-party transactions that are significant. And we're talking primarily here about, when we say related party, we're talking about people who are usually related either through equity interests in related companies or through sort of family interests with other sort of entities. And so those have to be disclosed. And I don't know this particular last point is a big issue, but nonetheless, they have to be disclosed. And so disclosure is a big, 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 big topic. And so trying to disclose to the world what is happening, okay? And then notes to financial statements go on and on and on. And so here we talk about significant accounting policies and what are those policies and how do we choose between things like FIFO or LIFO and dollar value or LIFO and all these other variations on these various twists on valuation. Also subsequent events. This is important because things can happen where companies, so let's say we have just in very generic terms, a December 31st year end, and we're going to produce our financial statements, we're going to give them out by March 10th or whatever. But meantime, between December 31st and March 10th, something really, really important happens, something catastrophic happens. And it could be good or it could be bad, right? But it does not impact the reporting period that is under examination. And again, I use the January 1st to December 31st year end as sort of just as an example here. But this event did not happen during the reporting period, but it's important to disclose to users something has happened since then, right? Either good or bad. And sometimes it's bad, I hate to put it that way, but where maybe in a plant in Indonesia that caught on fire, it's destroyed, or there was a tsunami, right? And that took out our plant there. And so, I mean, these are things that we have to sort of disclose. And so, and also, and those which are what we call extraordinary items, but also more mundane items like issues of new debt or equity, any kind of acquisitions of companies, which goes on and all. Have we sold a major asset? Anything which may create a loss contingency. Okay, and so I sort of focus a lot of times. I think one of the sort of hallmarks of accounting is that we tend to maybe focus on things which are dangerous to the company, risky, uncertain, and can create loss, which is what risk really entails. Risk is the variability of outcomes, which in the worst case scenario is loss. And we do tend to focus on that much more than on the potential gain. And it goes to something we call the conservatism principle, which is probably overstated in some quarters, but it's the idea that we do not want to overestimate and be overly optimistic to users about the ideas about the events that might happen. So subsequent events are those things which happen between the period end and the reporting period, which are necessary to report. Okay, so those are what's going on there. Also, let's see. Oh shoot, let me scroll down here a bit. Noteworthy events, related party transactions. We talked a bit about that. Errors and fraud, if there are mistakes, unintentional, illegal acts, whatever. I have not seen a whole lot of disclosure about illegal acts and bribery. I think that's probably not something you're going to look forward to seeing very much. By the way, I'm a tax accountant, and on the corporate tax returns, there's a line item, a very specific line item that talks about income from extortion. And I know a lot of people think I'm just completely making this up, but it's simply another way that the government has to sort of track illegal activities. And if you don't record that, then they've got you on that as well. So illegal acts are illegal acts. And in the US, we have something called the Corrupt Foreign Practices Act, which is an act that seeks to prevent US companies, US-based companies, from bribing foreign officials to do all kinds of things. There are all kinds of problems with this law, and I know that, and but nonetheless, there are areas that should be disclosed, and I do not have a legal background, so I can't talk with a great deal of specificity here. I can only talk about the accounting aspect of it, but it's something we should think about if you're interested in it. All right, quick quiz. Concept check, which of the following would be commonly reported in the summary of significant accounting policies? Well, that would be B, the method of recorded depreciation. Again, these are all disclosures, pretty mundane, and by the way, if we have something like depreciation methods, FIFO, LIFO, whatever, and we change it, that's a significant event. But there's usually not that sort of a change, and it's a fairly big deal to go from one to the other. And then we go to the management discussion analysis. This was where management sort of in a prose environment talks about what's going on with the company, what's happening out there, what's going on the business world, what are we seeing, what are the trends, what's happening, and particularly related to things like our own operations, which are internal things, liquidity, which we talked a bit about last time, capital resources. So let's go back to, if I can find my cursor here, we'll go back to Apple statements. Let's just kind of go back up here, and I'll move. I won't. It's not going to be Apple all the time, but MD&A, management discussion analysis, which comes ahead of the financial statements, where management says this is what's going on. Now, in this case, we get Apple, and they're saying, hey, during this year, 2024, which is the most recent full year, we introduced things like the iPhone 16, the Apple Watch Series 10, and all that. And all these are things that are going on. So management's discussion analysis is basically a way that management communicates to shareholders and other users what's going on with the company, okay? And it's an important piece of it. This is a pretty small piece. I've seen MD&A discussion sections that go on and on and on and on and on because there's lots to say. So some of it's supplemented by things like schedules and whatnot, but nonetheless, you get the idea. The MD&A is an important section, and it also requires, toward the very end here, corporate executives to personally certify these financial statements. And I talked about this a second ago, where we drop all the way down, and the top managers need to sign off and say these are accurate statements. They reflect what's going on within the company, and we personally certify this. And again, the origins of this come from the early 20th century accounting scandals with companies like Enron and WorldCom and Global Crossing. And there was just a number of them that sort of broke out all at once. And all of us were sort of freaked out by what was going on. And I've never worked as an auditor before, thank God, I guess, right? But they were really sort of pushing the limits as to what's going on. And so Arthur Andersen, which was the accounting firm hired by Enron, basically went out of business, and they're no longer. And so you get the idea. This is not unimportant stuff. This is very critical to the operations, and so we need to understand how important compliance is, and compliance always will be. Okay. And then there's some discussion about compensation of directors and top executives. I think it's the top 5 reported people whose compensation is reported. Also, a proxy statement. If you're owner of a company, even if you have one share, you'll typically get a proxy statement. Usually, it used to arrive in the mail. Today, you probably have to go get it yourself, or it's emailed to you, and it entitles you to a vote at annual meetings. You've got to have a lot of shares in order to sort of sway, big companies and whatnot. But nonetheless, you do have, it is a sort of a democratic system where you do get a statement. The proxy means that you're substituting one party for another. And a lot of people will simply say, okay, management, you can vote my shares. You are my proxy. And so the management will decide how to put your shares. And so many people will just simply say, and by the way, that's sort of a default setting. If you don't return your proxy statement, you're implicitly giving management the right to vote your shares. Okay. for whatever the question is, and there are all kinds of questions that come up, compensation questions. By the way, one of the big questions right now we've seen is Tesla and Elon Musk's compensation proposal, which is just mind-boggling, and shareholders, I think, are going to probably go for it. I won't weigh in personally because I don't think anybody wants my opinion, but it's sort of mind-boggling as to what is being proposed to shareholders. So, all right, quick quiz, concept check. Where is management's discussion analysis located? It's going to be prior to the statement itself. And so, if you go back to the statement itself, just using this, and I'll sort of rotate among different companies as we get going here. The MD&A, management's discussion analysis here, financial statements are there. So item 7 and item 8, right before that, okay? And that's where those will lie. And so the ECHO system is nice because it kind of allows anybody, anywhere, you can pull up on your phone if you like to get all this information. Now, will you understand the information? Well, that's a different subject, but nonetheless, the information is there. And in the real world, people do slice and dice these statements and try to find out what the heck is going on with the company and ask a lot of pointed questions, particularly in the financial community as to what's going on. And so for the average person out there, maybe it's not apprehendable, but to people in the industry, it does make a lot of sense. Okay. And then finally, we get to auditors' reports. And so auditing is this function that we covered a bit in Principles 1, where we talk about what auditing is. Now, auditing is a function of both internal auditing as well as external auditing. And what we're really talking more about here, because intermediate accounting deals a lot more with external reporting, is bringing out independent auditors, external auditors, to examine the financial statements to make sure that they comply with GAAP standards, that they're accurate, that they make sense, that we're not overstating things or understating things, whatever the case might be. And the auditor itself will attest to the fairness of the statements. And ultimately, they will prepare an auditor's report. Okay. All right. And only CPA firms can do this. Only CPAs can do an audit and sign an audit. So there are a lot of accountants out there who are not CPAs and they cannot do audits, right? Particularly in public companies. And so in this case, we've got 4 different classifications, and it goes from best to worst. Unqualified is best, obviously. And that's basically saying we attest to the fairness of the statements, that they accurately present the financial position and operating results of the company under question. So that's the best. Unqualified with explanatory emphasis paragraph. This is not all that unusual. There are cases in which auditing firms will disagree with management over the interpretation of certain laws or certain accounting treatment. It does happen, and I've seen it quite a lot in financial statements where the auditors will say, these are areas where we disagree with management. We agree to disagree. So users, external users, know that we don't agree with that, right? That's not probably a majority of cases. What usually happens is that sometimes there'll be a meeting of the minds, and they'll get to that point where, and they won't get to that point, but it does happen. A qualified is not what you want to see, and definitely an adverse or disclaimer is not what you want to see. A qualified audit is where we're saying, yeah, okay, there are things that are going on here, and that we will tell you with a little bit of assurance that things are accurate. And there are cases in which these things go from bad to worse, and we're going to sort of go through these here in the time we have going on. So first of all, let's go from best to worst. The unqualified report is what we call a clean opinion, where the outside auditors, external auditors, who have no interest in the company itself, and these are typically dominated by the big 4, KPMG, Ernst & Young, or EY, PricewaterhouseCoopers, PwC, Deloitte. For the big companies are the ones that do that. But for smaller companies, even smaller publicly traded companies, there are firms that handle audits, and so they will issue an opinion. And there is liability on the part of auditors to issue, if they've got it wrong. And if you need any evidence of that, look at what happened to Arthur Andersen, which was really one of the very top firms in the world prior to 2002. But in this case, an unqualified opinion is a clean opinion, where we're saying that the company itself, the client company, these are external firms, right, who have no connection to the company, are saying that the statements are prepared according to GAAP, and that we've done all these things, like we planned the audit well, we understand what's going on, we've certified the internal control procedures, and that we have attested, and that we are attesting the accuracy of the statements. And on the CPA exam, there's a particular section called auditing and attest, and that is auditors will attest to, that is, swear by the accuracy of the financial statements, right? So that's the best that we can get, and it's what we'd hope for. With explanatory paragraphs is a case where there's something that is maybe not quite up to snuff in terms of desirability. Maybe it's some sort of treatment that's not going well. There's a lack of consistency where we've sort of shifted methods between one accounting method and another, and so we've got some differences there. Or there are some material misstatements which the company does not agree with. Now, this is not, it's not unheard of, it's not common, but it's not unheard of, where auditors will say, well, we don't agree on certain things. And it does happen, and it is kind of there, and it's kind of left to the world to sort of agree with, okay? But here we get into these things like other audit reports, where we have, there's a need to issue something other than an unqualified opinion because of things like non-conformity with GAAP, inadequate disclosures, or a limitation or restriction of the scope of the audit. Now, I will say that I've heard from auditors before that sometimes management does not cooperate with auditors. Auditors want to look around, they want to crawl into things and start, scoping things out, counting the beans, counting the boxes and whatever. And sometimes management doesn't want that to happen. And it's very difficult. And I never worked as an auditor, but I had lots of interactions with auditors. And one thing I can tell you about auditing is that they tend to be in your business. And in some cases, being corporate headquarters says auditors are coming, and maybe some manager says, well, it's fine, they can come, but we're not going to really cooperate. That's difficult. That's difficult. So sometimes firms themselves, the client firms, will put a limitation or restriction on it. Now, hopefully that doesn't happen. Now, this is not something that anybody wants. Nobody wants, not the accounting firm, not the accounting or auditing firm, not the client firm itself. Nobody really wants that. And so hopefully that can be sort of worked out over time. But if it can't be worked out, it's difficult. One of the things that we should mention, and I do not want to make this an auditing course, but one thing that sometimes comes up is it's unpleasant situations where an accountant says to a client, I cannot help you, I am done, I'm gone, I will mail you my invoice to what I've earned, pay me, and I'm done, I cannot work with you. And I personally, I've never worked in auditing, but I've worked in tax, and there have been cases when tax clients are absolutely unworkable. They will not cooperate, they won't answer questions, they won't provide documents, and I've simply said, I cannot work with you, I'm done. I'm sending you a letter to end our engagement, and the engagement letter is nullified because you're not helping me. And so this is difficult. And if you're going to do an audit, you need to cooperate with auditors. And when I was a commercial lender, we had a number of clients who needed audits because they were government contractors, and so government really wanted auditing reports. And so, and they just simply did not know how to deal with auditors. And so it's difficult, and we tend to think of auditors as being cops. And if you don't like that idea, well, you should probably get used to the idea that auditors are sort of the cop-like presences, whether internal or external, either one. Okay, so this is the idea of an unqualified opinion qualified, something other than unqualified, I should say, and all that. So quick question, which disclosure provides independent professional opinion about the fairness of these? And that would be the auditor's report, and that's A, okay? All right, so what is the importance of auditing reports? Now, by the way, these statements that I showed, and I gave you an example of Apple, and I'll bring it other companies, EDGAR filings later. They're all audited by a public company, by companies that are licensed and approved to do public company audits, and they're going to provide information so that users can make good decisions, right? And the things that users are really interested in is the company at risk of default on obligations, okay? Are there operational risks? Now, by the way, default risks are more, can the company pay debts, particularly long-term in nature? Operational risk is how the company is sort of managing its business. Are they controlling costs? Are costs going through the roof? Are they controlling these? All these are questions that users can answer, but they can't do it unless they've got good information. And I mentioned on, I think Thursday of last week, where there's a proposal currently to make public company reporting on a 6-month basis, not 12-month basis. I'm sorry, not 3-month basis. And we'll see what happens on that. And I don't know. I really have no idea what's going to happen there, but obviously it's going to sort of slow down the receipt of information from users. And what that means, maybe it means nothing. I don't know. We'll find out. Okay. All right. The very last piece of this is financial statement analysis, which is something we talked a bit about in 2120 as principles 2. We sort of carried it over. So the text we use for both principles 1 and 2 have, I think, run from chapters 1 through 18. We sort of cut off principles 1 at chapter 9, and we sort of rolled this over into principles 2, which is really more of a managerial accounting section, but we did it to sort of even out the workflow, the amount of content. And financial statement analysis is really what's going on there. And what are we doing here? We're trying to ascertain what the relationships are between reported data and what it all means. We're trying to sort of make meaning this information that's given to us, all these numbers and all this other jive that's coming. And so we talk about comparative financial statements. And we're going to get into these a bit, talking about how we present information year to year and what's happening, what are the trends that's going on. Horizontal analysis is where we convert it to a percentage, where we say, okay, and from one year to the next, what is the dollar amount of change in, I don't know, what cost of goods sold or whatever, and then what are the percentage changes? And so it allows us then to understand what's going on over a time period. That's what horizontal analysis is, 2023, 2024, 2025. And then when we talk about the percentages, we're simply, if it's a balance sheet, we're taking it as a percentage of net assets. If it's a, I'm sorry, net assets, total assets. If it's an income statement, as a percentage of net sales. And so we can compare it year to year what's going on. Vertical analysis is within the same time period, where we're simply taking the percentages and we're sort of looking at it. And by the way, horizontal analysis and vertical analysis, they're sort of presented as something apparently different from one another, but they kind of work together. It's not, they're two different things, but it's like shoes and socks. I mean, they kind of go together. You got to kind of work them both at the same time, because vertical analysis will tell you what's going on within a particular accounting period, but it may not make any difference or any sense unless you convert it to what's going on over time. So I think that's really important. And we'll get to some examples of horizontal analysis, which is a time series sort of layout in percentage terms based upon those, in particular balance sheet and income statement. You can do it to a cash flow statement if you want, and some do, but these are the big ones here. And then the vertical analysis is what's going on within the accounting period. Ratio analysis is where we simply take financial statement information and do a number of different comparisons to determine what's going on with this company. And more importantly, how they benchmark against the industry itself, potentially, and just common sense. And these are things, when we get to ratio analysis, and I don't think we're going to get here in this particular video, I'll talk about whether or not higher is good, is good, higher is better, or is lower better. And so we'll have to talk about what they are and go from there. So quick concept check: risk, which the following describes the risk that the company cannot pay its obligations. Well, this is default risk, right? That's the issue there. So, all right, so this is a good stopping point. So what I'm going to do is I'm going to sort of pick this up. We come back on Thursday. We need to get through chapter 3. There's always a lot to do in intermediate accounting. So I'm going to come back hopefully today if I can get the room reserved. It's hard. This room is occupied by another instructor right after this. But I'm going to pick it up from here, and I'm going to talk about the rest of this, because what I want to do on Thursday when we come back is begin chapter 4. So we have a good 3 class sessions to talk about chapter 4, which gets into the income statement. And I really want to spend some time talking about the income statement and elements of that, sales, cost of goods sold, and all that. So, okay. So I will finish this up on a separate video. You'll see me doing this a lot. I've already been doing it just because there's a lot to do. And I want to spend more class time as we get deeper into it, doing actual postings, debit, credit sort of things, so that you can more easily do the homework and quiz and bonus activities, okay? All right, any questions for me about anything before we wrap it up? All right, have a great rest of your day. I'll see you on Thursday.
Thank you, sir.
Yep.
The reason I thought the class was at 11:30.
Oh, that's.
I don't know why.
Your brain just like, no way it started.
Then yeah,
That's not reasonable. 11.
yeah, I was getting ready to eat something and then I was like, I gotta look at it. I was like, oh, shit.